Welcome back to my channel where we dive into the world of personal finance and uncover strategies that can help you manage your money smarter. In today's episode, we're uncovering a strategy called infinite banking. It's a strategy that may sound complex, but don't worry, I'm here to break it down for you. Whether you're a seasoned investor or just starting out, this should give you a step-by-step analysis on how you could potentially use infinite banking in your strategy and how it could work for you. Infinite banking is a financial strategy that allows people to use their life insurance policy as their own personal bank. This concept was popularized by Nelson Nash in his book, Becoming Your Own Banker. The idea is simple yet powerful. By overfunding a whole life insurance policy, you can use loans from yourself as your own personal bank instead of utilizing a traditional bank loan. The core of infinite banking is a whole life insurance policy. This is a life insurance policy that provides death benefit for your entire life, but more importantly, it provides a cash value as part of the policy itself. This cash value grows at a guaranteed rate, plus you get a dividend, and that accumulates over time, and that's what you have the ability to access in the form of a loan to utilize for anything you want. But let's dive into how infinite banking actually works. Imagine you're the bank. You make regular, larger than required payments into your life insurance policy. By doing this and overfunding your policy, it accelerates the cash value inside of it. Once you've built up enough cash value, you can then start taking loans out against it. The beauty of this, you set the repayment terms. Now, a common misconception with infinite banking is that the interest that you pay into the insurance policy is actually going into your life insurance policy. So people often say you're paying back interest to yourself. That's not technically what's going on here. What's actually happening is when you take out a loan against your own policy, you're going to pay a simple interest back to the insurance company. That interest is literally going to the insurance company as a cost. However, when you have a loan out against the policy, your cash value will continue to earn compounding interest as if those dollars never left. So you have a simple interest that you pay, but you're also earning interest on the dollars that you have outside of the policy. So let me give you an example. Let's say you have $100,000 sitting in your cash value, and you take out $50,000 of that to go out and invest it in a piece of real estate. You're going to pay simple interest every year on the policy loan. However, inside the cash value, it's growing as if you still have $100,000 sitting in the policy. So even though you took 50 out to go out and utilize it somewhere else, your money's still compounding as if it never left. So you start earning interest in two different places with the same dollar. Now you are paying a simple interest, but you're also earning a compounding interest on the same dollar. By doing this, over time, there's going to be an added layer of profitability simply because of simple interest versus compounding interest. Sometimes you have the ability to actually create a positive spread for yourself where you're actually paying less interest than what you're earning in your policy. This is a great scenario and it only adds to the profitability of the strategy. But I want to be clear, even if the interest rate is the same, you're paying a 5% simple interest and earning a 5% compounding interest over the course of 10 years, there is going to be an added layer of profitability for the person that owns that life insurance policy. This is how the majority of my clients utilize these policies. And a lot of people understand this concept as infinite banking or becoming your own bank. What we call it is the investment optimizer. The reason I like to call it the investment optimizer is because I'm hyper-focused on my clients utilizing this policy to go out and create wealth or to generate cash flowing assets in the form of real estate, syndications, any sort of cash flowing investment, even in their own business. I want to be clear that that concept works. You can go out and use a policy loan to buy your car cash and then repay yourself, and you will have an extra layer of profitability. You'll save yourself money instead of paying a credit union 4 or 5% interest on the car loan. However, my clients are hyper-focused on creating wealth, and so they're going to take loans and invest it into different alternative assets. In summary, infinite banking or the investment optimizer is about taking control of your financial life by utilizing a whole life insurance policy. It's a powerful tool for wealth building, offering flexibility, tax advantages, and the potential for financial independence. However, it's not without its complexities and costs. Whole life insurance policies can be expensive, and it's important to consult with your advisor or your financial agent and make sure that this is something that actually works for what you're trying to accomplish. I offer a ton of free content on my YouTube channels, helping explain how this strategy works, diving into it a little bit deeper. As always, you can go to the link in my bio and schedule a call with somebody on my team. This strategy isn't for everyone, but for those who can make it work, it can be a total game changer. That's all for today's episode on infinite banking. I hope you found this helpful and enlightening. If you did, please give it a thumbs up. Make sure to click that subscribe button, turn on the notification bell so you don't miss another episode. episode. If you have questions or want to share your thoughts, go ahead and drop it in the comments. Until next time, take control of your financial destiny and make your money work for you.